Rồi, chào mọi người. Welcome to the loan mentoring program or class. Okay, so today is the 12th class. Today I will try my best to wrap up, all the loans programs. Okay, I will go over to the remaining traditional and non-traditional loan programs. So at least you now know all different kind of programs out there, right? Conforming, non-conforming, traditional, not traditional, um, primary market, secondary market, a lot of good information. So after today, we're gonna talk about activities and stuff. Okay. All right, 12 class. Wow, you guys stick with me for 12 classes already. Awesome. I love that. All right, so nothing changed on this diagram here. Okay, all the laws still here. Okay, so continuing with the I think we wrap it up the non-traditional loan program last time. Okay, but now we're going to come back a little bit on the conventional loan program. Okay, the so we know that anything that conventional, meaning that it meet the guidelines, it meet the standards, right, of the Fannie Mae and Freddie Mac. Because if it's meet those guidelines, then Fannie Mae and Freddie Mac will buy that loan back, through the secondary market, so that the lender have money to go out and lend again. Okay, that's the whole idea, right? So conventional, that's also a conventional, but it's called non-conforming. So we have conventional, conforming in meaning that it meet the standard. Okay, non-conforming meaning that it's not meeting the standard. Okay, but still a conventional loan. Okay, the FHA set out, right? So if the county have a loan limit of 725,000, then anything above that is called jumbo loan. Okay, jumbo loan could be up to 725 to $1,050,000. Okay, then anything above $1,050,000 amount, probably going to consider a super jumbo. Okay, so those are non-conforming loans. Okay, so the definition of a non-conforming loan mortgage is a home loan that does not adhere to government-sponsored enterprises, GSE. Don't forget this, okay? Whenever you see a GSE, it's meaning government-sponsored enterprises. Which are those? Fannie Mae and Freddie Mac. Those are the two, okay? Which is not adhere to the GSE guidelines and therefore cannot be resold to agencies such as Fannie Mae and Freddie Mac. So non-conforming cannot be resold to GSE or cannot be resold through secondary market. Okay, investor may buy it, or whoever providing the non-conforming may keep it. Okay, and do an in-house servicing the loan. Okay, so usually the non-conforming mortgage carry a higher interest rate than conforming mortgage and also exceed the conforming loan limit. Probably in one of the classes I mentioned that it's not entirely true that non-conforming carry a higher interest rate. Not entirely true, right? Because like if you have a banking relationship with, let's say, Bank of America, Chase, Wells Fargo, right? When you take on a jumbo loan, a super jumbo loan, sometimes they give you a good discount rate too, and that eventually gonna lower the interest rate, right? If you make a huge chunk of deposit, like $200,000 in the bank, they give you half a point, right? You make a direct deposit, from your employer, right? Then you get maybe some point, a quarter point or an eighth of a point. Then after you close the transaction, you bring in another $300,000. They may give you half a point additional. So that those kind of incentives, by bringing more money to the bank, and they will give you a really good rate, a reduction in rates, I should say. Okay, and the thing, because like those loans, they're gonna keep it. They cannot resell to the secondary market, so they keep it. So they have a full control of it, and they have a good relationship with the customer, then they just keep it. Okay. Some requirements for let me see here. Requirements for an escrow account associated with a high price loan or a high cost loan. So any loan that consider we talk about the high price loan, and we categories are required to have an escrow account open, so that the servicer can collect upfront some of the mortgage payment, the insurance, as well as tax or PMI as well, right? Regulation Z currently requires creditors to establish escrow accounts for higher price mortgage loan. Remember that, right? Regulation Z, require that for any high price mortgage need to have an escrow account open. What is a high price mortgage? Okay, here's some review here. High price mortgage meaning the annual percentage rate exceeds the average time offer rate upper by a given amount. So now we're gonna talk some index rate here. Okay, we know that the APR stands for annual percentage rate. If it surpasses, it's more than the upper, which is an average prime offer rate daily, okay, by 1.5% or more, then it's considered a high price loan. Okay, so if the APR, right, you have a rate, you have all these kind of fees, PMI stuff, those kind of stuff. You add it up, right, and it's end up like let's say the rate is 4%, and if you add everything up, you may end up with 4.675, right? And if that 4.675, you subtract the upper and average prime offer rate, and if that remaining is 1.5% different or more, then that particular loan is considered a high price loan. Okay. If the first lien is a jumbo loan and it's an APR exceeds the upper by 2.5 or more, then it's also considered a high price loan. Okay, we talk about jumbo loan, right? Because this is a non-conforming, right? So we pass the loan limit. Now we reach into the territory of jumbo loan and super jumbo loan. But anything that if it's a jumbo loan, not the regular loan, right? Not the low low limit loan, then if it's a jumbo loan, and if it's 2.5% or greater than the APR, then it's considered a higher price loan, a high price loan. Okay, for subordinate mortgages, when you hear about subordinate mortgage, you consider a second, third, fourth lien of the property. So when you buy a house, right, you probably just only need one loan, so that's called a first lien. Okay, but if you buy a house that you need a second lien in addition to the first lien, then anything after that, you can open a second lien, you can open a third lien, right? Anything after the first lien is called subordinate mortgages. Okay, it can be happen when you at the purchase time, or it can be happen when you open a HELOC, right? You open, let's say you bought this home 5 years ago. Now you just have some equity in it. You want to get some money out. You want to go and renovate the house. So you need some money. You borrow the money, and that loan that you borrow against your home is considered a second lien or third lien, depending on how many loans you have, right? And that is actually called subordinate mortgage. So when you refinance, let's say if you want to refinance the first, right, then you need to have a subordination letter from the second and third lien. Say, hey, yeah, I know, I'm agree that you're okay with refinancing the first, or vice versa, right? You refinance the second, you need a subordination mortgage letter as well. Okay, so anything that you do, everybody need to know about it. Okay, because that is a risk mitigation. So any loan with a subordinate mortgage, second lien or more, is also considered a high price loan. 3.5 or more. So meaning that, let me see here. I try to figure it out. If it's the subordinate mortgage, I assume this is considered like combining everything, first and second lien and third lien, right? The subordinate mortgages, second lien, the loan is higher price if it's APR exceeds the upper. Okay, actually, it's just only consider the second lien or third lien. Okay, if the second lien, but the APR for that particular lien or mortgage, yeah, I'm referring lien and mortgage. It's the same thing. Okay, that if the APR of that particular lien is greater than the 3.5%, and this is a subordinate mortgage, right, and it's considered the high price mortgage. So it's not necessary that the first mortgage, APR, right? We already talked about that, but now it's considered this a high price mortgage if not second lien, surpass the 3.5. So what is a high cost mortgage? So we talked about high price. So what is a high cost mortgage? High cost mortgage is the first lien mortgage that has an APR. Here say specifically the first lien mortgage, okay, which is the first loan. That has an APR that is more than 6.5 percentage point higher than the average prime offer rate. Okay, the total lender broker point fee exceeds 5% of the loan. Okay, or the loan has a prepayment penalty beyond 3 years or 36 months. Okay, so if any APR that's 6.5% point higher than the average prime offer rate, if there's upper that 2.5, but you may borrow a loan that is 10%, okay, then that is considered a high cost loan. Okay, so that's just an example because it does happen. Okay, meaning that you may borrow the loan for investment property, or there may be a time that the interest rate is so high, that also considered the loan is the first mortgage is a high cost loan. Okay, and if there's a prepayment penalty beyond 3 years to 36 months, it's also considered a high cost loan. Okay, now we're gonna talk, we just finished up the conventional non-conforming, right? Now we're gonna move on to the subprime, the ARM loan program. Subprime and ARM loan program is the main cause of the 2008 market crash. Okay, because it's subprime, it's ARM. ARM means adjustable rate mortgage, meaning that the rate stabilized for a short period of time, then it's gonna go up and down depending on the market. So if it's happened that it's going up, big problem with the mortgage industry and then housing. Okay, which is now when it's going up, it's create what is called a payment shock, right? So if you have a 5% for 5 years, you pay 4 years, 12 months, that's okay. Let's say $3,000, and meanwhile the rate probably instead of 5 is probably 8 right now. Okay, and then by the time that you're done with your 5 years limit, when you step over to the 6th year, your payment probably double. So that create a payment shock. You probably pay $3,000, but now you have probably gonna pay $6,000 variable rate. It's gonna jump up and down every month. Okay, so that's create a payment shock. A payment shock refers to a dramatic increase in an individual debt and liabilities. Okay, that may cause them to default on their financial obligation or loan, not unable to repay. Right. Possibly payment shock occur when rather suddenly someone is obligated to pay more in monthly debt they can also, than they can afford. Right. So when the payment shock happen and that particular borrower doesn't have enough money to pay, then eventually it's gonna go to foreclosure. Okay. So that's why nowadays there's like strict guidelines on how somewhat the laws and guidelines control how a borrower take on a loan, and the borrower needs to understand what he or she got involved into the payment, and make sure that no payment shock happen, make sure their income and their debts and liability low, right, and their income high. So that way, they have the ability to repay. So what is subprime? Subprime is a below average credit classification of borrowers with a termish or limited credit history, which are subject to higher than average interest rates. Subprime can carry more credit risk. So subprime meaning that any borrower doesn't meet, the certain requirement, doesn't meet like certain credit score, or have some bad credit history, right? But subprime probably gonna allow them to to get a loan. Okay. But taking on a subprime meaning carry more risk. Okay, so even the lender, right, they want to make sure that when they offer the subprime to like a non worthy creditor or borrower, then they make sure that that person has the ability to repay. And some of the so when we're talking about subprime, right? Subprime is it's kind of any loan that is adjustable, right, with the rate adjustable, or what you should say like a variable rate. Okay, so the characteristic of ARMs, adjustable rate mortgage, including the indexes, we need all these characteristics to calculate the ARM. Okay, indexes, margins, discount, caps on rate and payments, negative amortization, payment options, recasting or recalculating your loan. It's kind of interesting that this last one, right, recasting, right? This recasting meaning that while you're taking the loan, there's something happen. Okay, either good way or bad way. There's something happen that require it to recalculate the loan. One example, okay, when the interest rate change, it's recalculating it. So after a period of time, the rate fluctuates, right? No longer fixed. Then that it's got recasting is recalculating, right? So in a way, right, recasting or recalculating maybe mean a bad thing. Okay, however, there's a good thing about recasting. Okay, recasting. Let's say you take a mortgage. You are responsible borrower, right? You promise to the bank, I'll make payment. Excuse me. I have good income, right? I'll pay the amount monthly. I am now may have some extra cash. Let's say 30 grand, right? What you can do, you can put that 30 grand and you pay in the principal. But instead, when you pay that principal, you only reduce the time. Okay, you don't reduce the monthly payment. So when you pay the principal, you only reduce the time, right? 30 years, you reduce to 25 years. Okay, but your payment going to be the same for all the remaining 25 years. But recasting is a good tool if the lender that the borrower is is having, like, let's say a jumbo loan or super jumbo loan, right? You call in and say, hey, I have 30 grand, I want to do recasting, meaning that I want to put my 30 grand to lower my total principal, but I need you to recalculate my monthly payment. The term going to be the same, nothing changed, but my monthly payment going to go down. So let's say if you have like 30 grand extra, right? You want to do a principal paid out, but you want to go through the recasting process. You may pay like maybe a grand, 1,500 for doing that program, right? But now, let's say you pay 3,500 a month for mortgage. Now with that 30 grand extra that you put in, maybe now you're gonna go lower down to 3,200. So you reduce your monthly payment by $300. Okay, just an example, right? So recasting is actually good in a way, right? And I think that sometimes happen when you have a jumbo loan, or whoever the lender is that has the recast program, then you can do that. So that is one way of reducing, the monthly payment. So know this, right? So that when you go out and you practice MLO, and the consumer, the borrower is scared of the monthly mortgage payment, but you see that, oh, this borrower has good income and maybe even better in the future, and they may have some cash, right? And they say, okay, what happened if I want to put my cash in? And then you use my example that I just explained it to you. to explain back to the borrower, saying, hey, if you have money, that's good. Do recasting if the lender allow. Okay, because some lender don't, but some lender do. Okay. Okay, so the types of the ARMs or adjustable rate mortgages, including the hybrid ARMs. What are the hybrid ARMs? Hybrid ARMs often are advertised as 3-1 or 5-1 ARMs. Okay, you may also see ad for 7-1 or 10-1, 10-1 ARMs. What does that mean by 3, 5, 7, 10, and there's a 1 after it? Okay, so this is how it's explained. ARMs is an interest only IO. Okay, interest only ARMs mean IO mean interest only. Okay, and IO ARM payment plans allow you to pay only the interest for a specific number of years. Typically 3 to 10 years. So that's what you see here, right? You may have you can pay interest only for 3 years, 5 years, 7 years, or 10 years. So that's why 3-1, 5-1, 7-1, and 10-1. So those first number corresponding to the number of years that you pay interest only, right? So the payment option ARM, an adjustable rate mortgage that allow you to choose among several payment options each month. Traditionally, you pay principal and interest. Okay, non-traditionally, you pay only interest. Okay, and sometimes that if you only pay minimum payment, okay, if there's a loan program that only it's actually allow you to pay minimum payment, but let's say if your interest is fluctuate up and down, then you're probably going to get involved into negative amortization, meaning that your balance is going to keep increasing, right, when you pay a minimum payment. Okay, I will explain a little bit more. We know what 3, 5, 7, and 10 mean, right? Number of years that we can pay interest only. But what's a 1, right? We're gonna go into that later. Okay, so some characteristics of the subprime borrowers, right? Subprime borrower is a person considered to be a relatively high credit risk for the lender. So that's called subprime borrower. Subprime borrowers have lower credit score and likely have multiple negative factors: late payment, collection, bankruptcy. Okay, so the thing is that the government, they want to cater the opportunity credit equal opportunity act. Remember that, right? They want to create an opportunity for anybody, regardless that you have a bad credit history or good credit history. Recently, we probably heard something that say good credit history actually pay more than the bad credit history borrower, and that kind of frustrated to a lot of people that try to build a credit score, right? So there are law came out say, hey, you get better benefit if you get a bad credit history, right? So I think the goal was that that they want to provide or allow bad credit history borrower to gain access to loan programs to borrow money to go buy homes. Okay. Subprime borrowers may also have thin credit history. They may be a new youngster that just joined the real world, and they don't have any credit history. They don't open any credit card yet. They haven't used credit card yet, so they don't have any history at all, right? So it's called thin credit history. Okay. They typically have the subprime borrower typically have credit score below 670 and the negative information on their credit reports. Subprime borrowers may find it harder to obtain a loan, obviously, and will usually have to pay higher interest rate, obviously, because you're high risk, you have to pay higher interest rate. However, many lenders are offering new products to serve this market. So like I say, right, they want to give everybody an equal opportunity to get the loan, whether you can afford it or not, you can approve it or not, but you do have access to those opportunities. Characteristic of subprime mortgage including stated income, non-income verification loan. What does it mean by stated income? What does it mean by non-income verification loan? What does it mean by low doc? Okay, so stated income meaning that you tell the bank, I make $100,000. That's what it's called stated income. Okay, but even though it's a stated income, you need to show, right, that you do have some transaction that deposit in your bank. Okay, even though that you say you have a stated income. Non-income verification loan. Okay, there may be loan that you don't even need to verify your income. Okay, low doc, meaning that there's a loan that probably doesn't require W-2, probably doesn't require bank statement, probably doesn't require what is it called? What is that? What's tax? Tax document. Okay, in a no doc or low doc loan, the lender doesn't require to bring proof of your income, but you will usually have to pay high interest rate. Okay, lender are generally charge more for the no doc or low doc loans. Okay, so that's a risk, right? You can access the loan, but you don't have to provide anything much, but your rate will be high. So subprime loan types including, number one, interest-only subprime loan. Number two, fixed rate subprime loan. Number three, adjustable rate subprime loan. Number four, dignity subprime loan. Okay, if the borrowers make their payment, so we talk about interest only, right? We talk about fixed rate subprime loan. Okay, fixed rate subprime loan is meaning that your credit history is probably bad, your credit score is bad, but you do qualify for get a fixed rate loan. Adjustable rate loan meaning that it's go for 3, 5, 7, 10 years and it's going to change, right? Dignity subprime loan is if the borrowers make their payments on time and above, they are credit worth. The interest rate eventually reduces to the prime rate. Okay, so if you're good borrowers, you are good payment on your rent, on your mortgage, right? And then your rate probably gonna drop accordingly. Okay, continue with non-traditional mortgage. Okay, characteristic of non-traditional mortgage loan including mortgages do not contain conventional characteristics. Obviously, non-traditional, right? Doesn't meet the the guideline. Also including suggest amortization schedule or standard and fixed installment payments. These mortgages may come with high interest rate. Obviously, any non-traditional gonna have a higher interest rate. Non-standard mortgage, borrower may be able to defer principal and in some cases interest payment until the full balance is due. Okay, so balloon and interest loan only, hybrid loans, and payment option adjustable rate mortgages are example of non-traditional mortgages, right? So we're talking about balloon payment, right, or balloon loan that you're gonna have a loan that go for 10 years, then once it's past that 10 years, you have to repay everything, right, in the balance. So it's called balloon loan. Okay, we're talking about non-qualified mortgage, right? A non-qualified mortgage or non-QM is a home loan that is not required to meet agency standard documentation required as outlined by the CFPB. Non-QM loan may encapsulate a wide variety of mortgages, including home loan that exceeding 30 years is called non-QM. Home loan that with negative amortization, that's a non-QM. Home loan with interest-only payment, that's non-QM. Okay. Non-QM loan may also exceed the CFPB current price-based threshold. So for the QM safe harbor APR, okay. So when we talk about safe harbor, meaning that it's a qualified mortgage, okay. And if it's if the non-QM loan that 1.5% plus the upper rate, which is equal or greater than the APR, then that consider a non-QM loan. A QM reputable presumption loan, okay, is an so when you're looking at this, right, I don't expect that you try to memorize this formula, but just for now, okay. So anything that that indicating the QM reputable presumption, meaning that the upper plus a 1.5 greater than the APR, but less than or equal to the 2.25. Okay, it's called QM, still qualified mortgage. Reputable presumption, okay, it's within this range. Okay, as long as if it's greater than the APR, right, it's still less than the upper plus 1.5, and the total whole thing is less than or equal to 2.25, then it's also called, you know, a qualified mortgage. Okay, so we know what an APR is, right? Rate plus fees, right? As long as that, okay. Actually, I'm sorry. This is not less than. The APR is greater than, right, the upper plus of 1.5, but that less than 2.25. Okay. So, you know, a couple more characteristics about non-traditional mortgage. We're talking about qualified mortgage. We're talking about non-qualified mortgage, right? Qualified mortgage lender must follow the ATR rule, ability to repay rules. Lender require thorough income documentation. Borrowers must meet lender's credit score threshold to qualify for a loan. Qualified mortgage loan may be backed by the government, okay, including VA and FHA. Interest rate conform to the current industry standard. Okay, what's a non-QM loan? Lender do not need to follow the ability to repay rule. Lenders may not verify income. Lender may extend mortgages to individual with low or no credit, not eligible for VA, FHA, and government loan. Okay. You know, interest rates are often much higher. Okay. Non-QM mortgage product, including bank statement loan, jumbo loan with 10% down, no income investment loan, assets-based loan, foreign national loan, interest-only home loan, recent credit event loans, commercial rental property loans. So, you know, we don't touch much about this, but you know, we do the non-QM with bank statement only. You know, jumbo loan with only 10% down. We talk about jumbo loan. Jumbo loan is anything that greater than the loan limit, but only 10% down. It's also considered a non-QM, right? No income investment loan. So these are different type of, you know, non-QM mortgage product. Okay, mortgage loan product, continue. Okay, purchase money second mortgage. A purchase money mortgage occur when the buyer obtain a mortgage from the seller of the subject property. The seller may use this strategy as a way to help sell the property, or perhaps the buyer lack credit or cash down payment. This type of loan may also be referred as a private mortgages. So we can call this a private mortgage because the seller is become a lender only if the seller, you know, able to pay a majority of the loan for his home, or already pay it off, so that they have equity that they can lend it back to the borrower. So because they lended the money to the borrower to buy their home or his or her home, then it's considered a private mortgage. The term that we usually call this is called seller financing. Okay, so seller financing has one advantage, is that for the borrower, right? The borrower doesn't get, you know, a strict guideline or requirement from the lender, like you need to have a credit score 670 or above, or you know, you need to have 20% down payment, blah blah blah, right? So with the seller financing or private mortgages, the seller is easy. Say, borrow my, you know, my money and buy my home, for example, right? So that way, it's help the seller, right? The advantage for the seller is it's help the seller to sell the home at the price that the seller wants, or at least sell the home, right? And the seller make more money after that too, because the seller going to get the interest from the buyer that pay back the loan, partially for the principal, majority for the interest. Okay, so that's what is called purchase money second mortgages. Okay, so when they say second mortgages here, it's meaning that if the seller, you know, probably hasn't paid off the loan, but still have some equity in it, so they may lend, you know, a mortgage to the buyer, maybe for a period of time, let's say 3 years, 5 years. Okay, and the buyer still can obtain the first mortgage from a bank, from another lender, right? Including the seller mortgage too. So that could be like second lien. The seller mortgage could be a second lien. Okay. Fixed rate mortgage, right? We talk about this. The characteristic of this, just a repeat. A fixed rate mortgage is a home loan option with a specific interest rate, for the entire loan. Comparison of type of loan, including term like 10, 15, 20, 25, 30 years. The shorter term, the lower the interest rate, and the faster to pay off the loan. Remember that, right? These terms, including 10, 15, 20, 25, 30, the shorter the term, the lower the interest rate, as well as the higher the mortgage payment. The higher mortgage payment because the majority of the payment going to the principal, okay, with the low interest rate, right? And imagine that you pay for 360 months, but now you go for 15 years, you only pay 180 months. If it's the same amount, then yes, your payment gonna be a lot if you're able to pay that. So meaning if you do, you get a good interest rate, okay, and the payment go majority in the principal. Okay, situation that affect a fixed rate mortgage payment, including economic condition, your credit score, your term, your loan term, your down payment, and other debt that you may have. Percentage of pay down required to lessen monthly payment, including 25% down payment. Get some discount. Okay, if you want to lower your interest rate, buy some discount point. Okay, sometimes it costs you 2,000, sometimes it costs you 5,000. Just lower by a quarter point or half a point. Okay, fixed rate mortgage with escrow. Adding an escrow account will increase your mortgage payment in order to cover your monthly tax and insurance. So we talked about the escrow account already, right? But here it's kind of interesting. Things like when you add the escrow account, yes, your monthly payment going to be higher because it's including the mortgage payment, it's including the reserve for the property tax, and it's including the money for the insurance, right? So that's why you say it's higher, but because it's just a reserve. Okay. Oh, let me see what it say here. Okay, so the you will also have to put in a little extra upfront in order to set up the account, right? Maybe 2 months payment, I believe. The good news is that it won't be more than 1/6 of your total escrow expenditure for the year. Let's say the whole year you need to put in 50K, for example, right? Then the amount in that account cannot be greater than 3 grand, right? A 6. If you take a 6 multiplied by 50, that it's like 3 grand. Is that 3 grand? Let me see if my calculation is right. So if you have a 50,000 for the whole year that you make payment out from the escrow account, then the reserve in the account needs to be, let's see, like about 3 grand. Okay, I was right. Okay, what is ARM? Adjustable mortgage, right? So payment option for the ARM is a monthly adjustable rate mortgage, which allows the borrower to choose between several monthly payment options, including the following: 30 years or 40-year fully amortizing, a 15-year fully amortizing payment, an interest-only payment, a minimum payment, or a payment of any amount greater than the minimum payment. Okay, so there's like a variety of options that you can use or can choose, to pay the ARM loan. Okay, fact on the index with the respect to ARM. Okay, interest rate caps. When you go with an ARM, right, there gotta be a cap on the ARM because like the rate cannot be go to 20% or 30%. There gotta be a cap. Okay, an interest rate cap places a limit on the amount of your interest rate can increase. Interest rate cap come into 2 versions: a periodic adjustment cap, which limit the amount the interest rate can adjust up or down from the one adjustment period to the next after the first adjustment. So when there's an adjustment rate arm, you know that the rate gonna go up and down. Okay, you may get a fixed rate, and then once you pass that limit, the rate gonna go up and down. Okay, but the first adjustment, meaning the first year after that fixed rate, the first year, right? The cap need to be at certain limit, and then a cap for the lifetime after that first year, right? And the cap for the lifetime going to be also have a cap as well. Okay, so it have two different cap: a periodic adjustment cap as well as a lifetime cap. A lifetime cap which limit the interest rate increase over the life of the loan. Okay, by law, virtually all arms must have a lifetime cap. Periodic adjustment cap. Here's an example. Okay, about the periodic adjustment cap. Let's suppose you have an arm with a periodic adjustment interest cap of 2%. Okay, the rate cap is 2%. However, at the first adjustment, the index rate has risen to 3%. A drop in an interest rate does not always lead to a drop in your monthly payment. Okay, there will be a calculation later that I'm going to show you. Okay, you know, when you're talking about adjustment cap, it's going to be really confusing. You have to spend like good amount of thinking, you know, into this to get the right calculation, because the formula, the math, and all that. There will be one question like this on the test, just to calculate what is the cap, what is the adjustment after first year, second year, third year, and so on. Okay, I will go over in depth a little bit. Definition of a fully indexed rate. What does it mean by the fully indexed rate? Okay, the fully indexed rate is the interest rate. But how to calculate the fully indexed rate? Including the fully indexed rate is equal to the margin plus the index. If the initial rate on the loan is less than the fully indexed rate, it is called discount index rate. Okay, then I will go in detail what does it mean by fully indexed rate. Okay, fully indexed rate scenario. For example, if the lender uses an index that currently is 4% and they want to make some profit, they add 3% to the margin. Margin meaning the profit for the lender. Okay, or profit including costs for the lender. Okay, so he is using a term called an index. Uses an index. There are several type of index out there. Index mean like a base rate, right? A base rate. Okay, so the fully index including the base rate plus the margin. So in this case, you know, the index is 4%, the margin from the bank is 3%, so the fully indexed rate is 7% total. Okay, keep that in mind. So if the index on this loan rose to 5%, the fully indexed rate would be 5% plus 3%. Now it's 8%. Okay, so if the index going up, the fully indexed rate going up. If the index rate going down, the fully indexed rate going down. Okay, going down compared to the previous rate, right? But you see the margin stay the same. Okay. Okay, factors when determining interest rate. There are 7 key factors to determine the interest rate, including a borrower get a good interest rate or a bad interest rate, depending on these 7 key factors. Credit score, the home location or the property location, home price and loan amount. How much you buy, you know, the home for, and how much you're gonna down, and how much of loan that you're gonna need. The down payment is a key factor. The loan term, you want 10, 15, 20, 25, 30 years. Okay, interest rate type. Okay, what type of interest rate is that? Okay, is it an ARM? Is it a fixed? A loan type. Is it conventional? Is it a non-conventional? Is it QM? Is it a non-QM? Okay, so those are the factors that determine the interest rate. And every time nowadays, after 2008, right, the lender needs to send out a consumer handbook, which is called CHARM booklet. Must provide the booklet to the borrower within the 3 days of a new application. So this is part of the disclosure. Okay, the broker or the lender need to send this booklet and all the disclosure to the borrower within the 3 days. And usually it's going to including the loan estimate in there as well. 3 days after the loan application open. Okay, so now I just go ahead a little bit. So meaning disclosure, initial, what are the disclosure requirements? Okay, initial interest rate adjustment disclosure. Send to a consumer at least 210, but no more than 240 days before the first adjusted payment is due. So here, disclosure here is we're talking about the adjustable rate, which is ARM. Okay. So the adjustment meaning that okay, you may have a fixed rate for 5 years, the 6th year is going to be adjusted, right? So meaning that you need to send out a notice, or the lender need to send out a notice 210 days to 240 days, not more than 240 days. A notice, a letter to tell the borrower, hey, Mr. John, your rate will be adjusted within, let's say at this date, right? And that notice needs to be sent out, between 210 and 240 days. The first interest rate adjustment, okay, we talked the initial interest rate adjustment. Now, after that initial adjustment, meaning that the rate gonna adjust the first time up a little bit. Now, any subsequent adjustment, right, that need to be sent out 60, but no later than 120 days. So you're gonna talk to Mr. To me, because like it's can adjust like for the after a year after the previous adjustment, right? So 60 days before the second adjustment coming in, or 120 days before the second adjustment coming in, the lender need to send out a disclosure. Say, hey, Mr. John, this is gonna be your first adjustment after the initial adjustment, right? Get ready. If you don't have money, make sure that you go do second job or something, right? If you okay, then this is just a notice for you. Okay, ongoing interest rate adjustment disclosure. Okay, this disclosure need to be sent to a consumer at least 60, but no later than 120 days before the adjusted payment is due. Okay, so like any subsequent adjustment, same thing every year, right? You need to send out between 60 and 120 days, or 2 months or 4 months, before the next adjustment happen. Okay, we're talking about the balloon mortgage product. Fact about balloon mortgage: if you have a mortgage, I think we'll just cover that. But okay, now we need to deep dive a little bit what the type of balloon mortgage including. Balloon payment, right? In this case, the initial monthly payment might be calculated based on the typical 15-year or 30-year amortization schedule, even though the loan term might only be 5 or 7 years. So meaning that, right, it's a balloon program, it's a balloon loan, it's requires some balloon payment at a certain period of time. Let's say it's a 5-year balloon, meaning the first 5 years, you're gonna pay the mortgage based off the term of 15 years or 30 years. Okay, and that mortgage payment gonna stay fixed for 5 years, right? And then after the first 5 years, balloon kick in, you have to pay the entire amount. Or if the loan term is like 7 years fixed, then after the 7 year, then you have to pay the remaining, or you have to refinance. The borrower has to refinance. Okay, we talked about interest-only payment. Interest-only payment in this scenario, you only pay the interest on the initial period. When that period over, you owe the remaining balance of the loan. Okay, so you have to pay back everything. A lot of this is hot money loan, right? Some people go out and borrow the hot money to buy a home, investment property. It can be fixed for 6 months or 6 months to 24 months, right? And they pay interest only for those months. And then when the time comes, they have to pay back everything, or they have to refinance it. Okay, continue with mortgage loan product, reverse mortgage loan product. Okay, what is the reverse mortgage loan product? Right, we talk about this, right? But let's deep dive into it a little bit more. You want money to pay off your mortgage, supplement your income, or pay for healthcare expenses. You reverse your mortgage if your property have enough equity. So you can go to the bank and say, I want to do a reverse mortgage. I want to take money out, pay for my healthcare, for all my life expenses. convert a part of your equity in your home into cash without having to sell your home or pay additional monthly bills. So meaning that you don't pay mortgage no more. The bank gonna pay you, and you use that money to do whatever you want to do. Okay, and then you don't pay the mortgage. But the bad thing about that is that you're pulling out your equity, right? A reverse mortgage can use up the equity in your home, which means fewer assets for you or your heirs. So meaning that if you use all that equity, eventually you're gonna drain out your equity in that property, right? Or let's say if market dip, then you cannot like take out the whole thing, but you probably only take out a majority portion of it, right? Let's say 3/4, for example. Okay, you don't have to pay back the money for as long as you live in your home. So meaning that when you take out that money, your equity, you don't have to pay that money back to the lender as long as you live, right? And live in that home. If you die, the bank gonna take your property. So when you die, sell your home or move out, you and your spouse or your estate would repay the loan. So meaning that if you decided you want to sell, you take the reverse mortgage for a couple of years, you still have equity, and you decide to sell, then now you have, if the home still have a mortgage, you have to pay the mortgage, and then you also have to pay the money that you took out from the reverse mortgage too. Okay, and hopefully you still have some money left, or at least it's covered those two mortgages. Okay, it's covered the original mortgage and also cover the loan that you take out as a reverse mortgage. So reverse mortgage is pretty much is a loan. Okay, it's not actually anything magically happen, right? So because it's a loan, like when you drain out your entire equity and you're still alive, and let's assume you're the only person in no spouse, then when you die, the bank gonna take that property. Okay, if you have a spouse, then okay, I think we can move forward a little bit. So the type of reverse mortgage including single purpose reverse mortgages. What is that? It's the least expensive option. The lender may say the loan may be used only to pay for home repairs, improvement, or property taxes. So meaning that you take the reverse mortgage as a single purpose reverse mortgage. So you take that money, you own some, you take the money just for home repair, you take the money just for improvement the home, or you take the money just paying the yearly property taxes. So meaning every year, let's say I allocate 10 grand for repair, 5 grand for my property tax, right? And if I want to do any improvement, I can request more money. But if not, then I have a fixed number of cash that I put out just for the paying these purposes. So that is called single purpose reverse mortgage. Proprietary reverse mortgages, including the private loan that are backed by the company that developed them. Okay, so proprietary reverse mortgage, you can get a reverse mortgage from a bank, from a lender, from a financial institution, from a Chase, Bank of America, whatever. But there's also a private company that offer that kind of loan too. Okay, that is what it's called, a proprietary reverse mortgage. Home equity conversion mortgages, or HECM, which is a federal insured reverse mortgages, are backed by the U.S. Department of Housing and Urban Development, HUD. HECM loans can be used for any purposes. You can pay for your kid's school, you can pay for your debt, you can buy a new car, you can pay whatever you want to pay. Okay, so the HECM is I think it's a really big loan. And like I said, you take the money out, you drain your equity, and you stay in the home until you die, and the bank take it over. In order for you to be able to take the reverse mortgage, that borrower needs to be 62 years old or 62 years or older. So remember that. Okay, 62 is a magic number. When in the test, they say, what is the limit age for the reverse mortgage? They give you a bunch of numbers and pick the 62 number. And that 62 is by the time you're closing the request for the reverse mortgage or close of escrow. Okay, by that time. Hold title to the property. You hold the title to the property. Okay. Currently occupy the property as their principal residence or intend to occupy the property as their principal residence. right? If you decide that you're gonna rent it out, if you decide that you do whatever, then the bank gonna take back that loan that you take out through reverse mortgage. Have no delinquent, on the federal, not be on the HUD, LDP, or executive party list. Okay, this is some kind of, let's see, the HUD, LDP, executive, some government stuff. Okay, attend required HECM, so you need to have a counseling. Okay, sign a required borrower certification. Like you need to sign document that say I'm taking this reverse mortgage. I want to take money back for my equity. Meet the financial assessment requirement. So make sure that whatever the money you take out still support your life. Right, you cannot just take it out and then you still struggle. Right, the program won't allow that. Okay, reverse mortgage loan product. Okay, we talked about this. HECM let you choose among several payment options. Single disbursement, right? You can take one single disbursement. This is only available with a fixed rate loan and typically offer less money than the other HECM options. The term option, fixed monthly cash advances. So monthly you get the cash back from the lender for a specific time. 10-year option, fixed monthly cash advances for as long as you live in your home. Okay, line of credit, you can take the reverse mortgage loan as a line of credit. This lets you draw down the loan proceed at any time in amount you choose. So meaning that you say, okay, I want to take out the reverse mortgage as a line of credit, but I probably not going to use it. Whenever I need it, I just write my check to myself, then I'll cash it out. Okay, so meaning that you have a credit line available through the reverse mortgage loan. But you think, hey, I may not need it yet. I just have the credit line available so that whenever I need it, I use it instead of have to wait to get approval and all that, right? And combination of monthly payment and line of credit. Okay, meaning that you can have an option with the monthly payment from the reverse mortgage from the bank, from the lender, and you can also have a portion of it as a line of credit. So kind of different combination. Scenario that cause a full balance to become due loan is due and payable, and HUD approval is not required. So meaning that if you take out the reverse mortgage and if you violate any agreement, then it's going to be due, meaning you have to pay back all the money. Okay, what are they? All borrowers have died, meaning that reverse mortgage that you take can be a husband and wife originally on the loan. So now if both of them die, the bank gonna take the property, right? If the equity is already drained out, the builder or the bank doesn't have to worry about it. They just take the property. However, if there is some money left in the property, then they may have to short sell it and then return any money left over to the heirs, right? Maybe to a will, to a trust, or whatever, right? All borrowers have sold the property or conveyed title to the property. So meaning that, let's say you decide that you're gonna, husband and wife decide to take a reverse mortgage, but silently they change the title. They put their son's name on it. They take their name out. Okay, when that happens, you have to pay back. Okay, the lender find out, you have to pay back. So do on sale clause or do on sale like title transfer. Okay. Due and payable is deferred when the last surviving borrower dies and an eligible non-borrowing spouse was identified at loan of closing. So meaning that if husband and wife on the loan, the husband died first, the wife still take money out until she died. Okay, or this is a special case that the husband is the only one that on the loan, right? But he also married and he has his wife live in the home too, right? The borrower died, the husband died, the wife is not on the loan, but still live in that home. She can live in there until she dies. Okay, and nobody can take that property from her. Okay, the property is no longer the principal resident, meaning you have to pay back the loan if you rent it out, if you share a room or whatever you do. Okay, you sell it, you have to pay back. Borrower does not maintain the property as a principal resident for a period exceeding 12 months. So meaning that, let's say if the borrower, single borrower, right? He need care, he need adult care, right? He go into a nursing home. But if he stay in a nursing home for more than 12 months, then eventually that money need to be returned. That home need to be sold so that the money can be returned back to the lender. Okay, so that's a special case. If that borrower go to the nursing home, feeling well, come back home before the end of 12 months, then that continue. Otherwise, the money need to pay back. Borrower failed to pay property charges and all attempt to rectify the situation have been exhausted. So meaning that anything wrong with the property tax lien, judgment, anything like that, right? All that the borrower had to try the best to rectify that, to resolve those issues. Otherwise, the bank, if too much, the bank gonna take the home and sell and get the money back. The property is in disrepair, and the borrower has refused or is unable to repair the property, right? If the condition of the property is too bad, then the bank gonna require, the borrower to pay back the loan, foreclosure it. Okay, talking about the okay, I'm a little bit run over time here. Mortgage loan product, HELOC, right? We're talking about HELOC. HELOC is just like a line of credit that you using your equity, you open it, and then you can use it whenever you want to. You can use that HELOC to pay for your kid education. You can pay for a loan car, or you can even use that to pay down or to put down as a payment for the next property that you want to purchase. Okay, what does it mean by an open-ended credit loan? Okay, HELOC, open-ended HELOC. They are a revolving source of fund, much like a credit card that you can access as you choose. So open-ended meaning that you have a HELOC open, okay, and the rate is variable, it's not fixed. So that's called open-ended because you haven't fixed it, right? Or you haven't used anything in that HELOC. Okay, once you use it, they will charge the interest rate on it. And if you haven't fixed it, then it's going to be variable and it's called open-ended. But once you fixed it, then it becomes a closed-ended loan. So that particular, so you may have a HELOC of $100,000. You borrow $50,000. You can just fix that $50,000, and that $50,000 become an ended loan. Okay, and it's gonna have a fixed payment, and you still have another $50,000 in the HELOC or the credit line. Until you use it, you can lock that in, or you can combine both of them. Characteristics of HELOC: lower cost than many other type of loan. Instead of go out and buy, borrow some loan to buy something, you can use the HELOC, to do whatever you need to do. Back in 2021, the HELOC was like, really low. The rate was really low, so people using HELOC, more. The ability to borrow a relatively large amount of cash using your equity, of course. Potential tax break if you use the fund. So it's a great thing, right? You borrow your own money, but because you borrow it, you have to pay interest on it. And when you pay interest on it, you can claim that interest when you do tax. Okay. The safety of fixed interest rate on home equity loan. Fundamental of construction loan. Okay, now we just go over to the next new loan, construction loan. The definition of construction loan is a short-term loan that covers only the cost of custom home building. So you want to borrow a loan, a money to build a home. So that is called construction loan. Once the home is built, the prospective occupant must apply for a mortgage to pay for the completed home. So you can borrow a construction loan to build the home. Once the home is complete, you go out, you borrow another loan, you refi and pay back this construction loan, and then you carry that new loan as a primary, resident loan, or even an investment property loan. So classifying the disclosure of financing: if the creditor treats the loan as one combined transaction, the creditor discloses both construction and the permanent financing combined on each disclosure. So there's several ways of getting the money out from from the construction loan, right? And depending on the way, then if it's a construction and if it's a permanent financing, then different disclosure need to be happen. If the creditor treats the loan as a separate transaction, it provides a separate set of disclosure for each phase of the construction permanent loan. So when you borrow a construction loan, probably they're not going to give you the entire amount, right? You say, okay, you need to finish the phase one. I'll give you the money. Just finish the phase one. Once you're done with phase one, I give you the money for doing phase two, and so on. Okay. Construction loan, sometimes that you have like you build a whole community, right? Then sometimes they blanket it, right? They give you the money to build one home. When that home is done, that money need to be returned, and then they let you borrow the money to build the next home. Okay. Required payment on construction loan. Okay, these are the way that to pay back. The projected payment table include payment information about the principal and interest, mortgage insurance, estimated escrow, estimated total monthly payment, and estimated tax and insurance and assessment. Okay, so those are the thing that's going to include in the payment. Adjustable payment, AP. The adjustable payment table include information about interest only payment, optional payment, step payment, seasonal payment, and other details regarding periodic principal and interest payment. So there are like so many different ways that you can set up the payment with the lender who offer the construction loan. Okay, mortgage only, interest only mortgages. So we talk about this, right? What are the facts, right? Interest only mortgage is one where you solely make interest payments. So we know about that. For certain time or several years, interest only payment may be made for specific time period. Okay, anything after that period will be adjustable. Usually interest only loan are structured as a particular type of adjustable rate mortgage or ARM, ARM. While interest only mortgages mean lower payment, for a while they also mean you earn build up equity, right? So meaning that because you only pay interest only, meaning that you don't pay back the principal. You don't pay back the principal, you get no equity, right? Because you only pay interest. Let's say you borrow 500,000 and you pay interest only for the first 5 years. Guess what? After the first 5 years, you still owe $500,000 because you not pay a dime into the principal. Okay. Other mortgage product, including hot money loan, use hot money loan for a specific purpose, to win an offer in the seller market, for example, right? Nowadays, there's a lot of competition. Buyers are waiting to win a home, but because their financial situation, they are not strong enough, so they're using the hot money loan, right, to fight for an offer, right? Borrow for a short period of time, definitely high interest rate, and there's some upfront fees. Sometimes has a prepayment penalty too. Hot money loan is actually a cash equivalent loan, similar to hot money, but the cash equivalent loan is a hot money. Okay. So I think that's pretty much it. These are all the loan technical terms. Okay, try to familiar yourself with these terms. For example, loan terms, including junior lien, is like lien that is not the first mortgage. Subordinate loans are also a lien. Lien that subordinate is a loan that after the first mortgage. Escrow account, we know about that. High price mortgages, we know about that. Table funding, we just talked about that in the previous slide, right? Rate lock agreement. Okay, you give the client a rate. The client can lock it now or lock it in the next few days. It's called lock. So meaning when they lock, that rate going to be honored, right? So if you lock for 4.5 and then it's going to take 30 days to close the program, your rate's still 4.5. Whether the rate is going down for 3.5 or going up for 7.5, your rate's still guaranteed. Tolerances, right? We're talking about tolerances. What kind of the service, the fee, and all that, right? Legal title granted via a mortgage, how is the title divided between the owners? Okay, husband and wife community, partnership or joint tenants and stuff like that. Okay, what are type of mortgages a lender cannot be forced to repurchase, right? Non-QM, for example, right? Secondary market, facts on the lien, delinquent loan, high cost loan, early payment default. I just want to go through this, right? So you need to know all these terms, what they mean. Okay, foreclosure, use spread premium, high interest rate, federal mortgage loan, qualified mortgage, servicing transfer, lender credit, discount point, 2-1 buy down, accrued interest, loan to value, settlement, finance charges, loan origination fee, debt ratio, daily simple rate, the whole thing. So you read it yourself. Okay. Sorry, I'll overrun 12 minutes. Okay, so that is all, all the information about majority of the loans that you're gonna be working with, right? When you become an MLO. Okay, traditional, non-traditional, conforming, non-conforming, jumbo loan, arm loan, how to calculate the the fully indexed rate, right? Right? Anybody have any question?
Yes, I have one question. Yeah.
Mm-hmm.
So for the commission, so for some lender, they allow loan officer to decide the commission, right? So it means that we can get any like 1%, 2%, like we can decide it, right?
Yes. Okay, so this is how it works. Commission. Great question. This is why we're here, right? This is why we're taking this course. This is why we want to become an MLO, because we want to make money. Okay, so how the commission is calculated? Let's think of it this way. The commission we get is what the buyer gonna pay, right? So meaning that is also draw a competition in the market. Some MLO or some broker or some lender, they're willing to charge less, make less, and get volume. Okay. Some people, they stand to the ground saying, I'm not gonna charge anything less than 2%. Okay, I need to make my 2%. If I can charge 2.75%, great. Okay, so now let's talk about the amount. A $400,000 loan, or 1%, how much you make? 4,000. Okay, a $400,000 loan, you charge 2%, you make 8,000. Not including fees and stuff that you have to pay. Okay, let's say you pick a broker that only charge you $500 for the file, $550 for a loan processor. Yeah, you may pay like $1,000, right? 1,100, let's say. You make $8,000, you pay 1,100. That's nothing. However, if you make $3,000, you pay 1,100. That's a 30% commission just chop up right back. Even though they don't divide 60-40, 80-20, right? You already pay up 30% of your commission to those fees, right? So yes. 400,000, 1%, that's $4,000. 400,000, 2%, that's $8,000. What about $1 million loan? $1 million loan, 1%, you make $10,000. 2%, you make $20,000. Is that crazy? If you make $20,000, you're more than welcome to pay that $1,100 right? So meaning now, if you are a good strategist, and if you know how to make more money, now would you do loan in the state that they only borrow 150,000 or 300,000, or you focus mainly on state that need more money, higher price properties, right? $2 million home, right? 20% down. Imagine that, right? So meaning any state that like California, Seattle, Washington, I mean, right? State that have a higher value home. So this is how you're gonna decide which state that you're gonna take for your MLO, right? The state that have higher price home, probably you're gonna make a lot more money than the state that only a couple $100,000. Let's say the state that have a $350,000 home, 20% down, maybe only take what, 300,000, right? Or even less, 250, let's say. 1% of 250, guess what? 2,500, not including fees, and then the transaction, and that's what the loan processing, right? So meaning that you make less by working more. You may have to work like 10 files to make up like $10,000, right? Or you can work 1 or 2 files and you already make $10,000, right? So now talk back to the commission. Okay, how we decide that the about the commission. So what happened is that when you join a broker, that broker have some agreement with the lenders, a list of lenders, 120, 130 lenders, and say, okay, with lender A, I want 2%. With lender B, I want 2.25%. With lender C, I want 2.75%. So the broker have that list layout, right, with each of the lenders, right? So when you say that you're gonna go with the broker, okay, because when a buyer take on a loan, the buyer as an MLO, right, you can decide if gonna be a lender pay or the buyer pay. Okay, what does it mean by the lender pay? The lender pay meaning that you go with the broker, and the broker have an agreement with the lender, 2%, 2.75%, then that's how much the lender gonna pay the broker, and in turn pay you, right? So that means that when you go with the broker option, right? In the broker option, you have 2 options too. Okay, in the broker option, you have 2 options: either the lender pay or the buyer pay. So meaning that the lender gonna pay that amount, and then you can readjust the amount that you're gonna give it, let the borrower pay, right? So that's an option. But if you go with the buyer pay, then the lender not gonna pay anything, right? So like I say, the broker pay or the buyer pay, that's one option. Within the broker pay, there's 2 options, right? A lender pay or the buyer pay, right? So that way, depending, because if you want to have the full control, right? And then you pick the buyer pay, and now you have to charge the buyer because the lender not going to pay a dime, right? They don't pay a dime, but they're going to give you a better rate, right? Otherwise, if they charge, they're going to include that, in the rate, which is going to get higher rate, right? So even if you go with the buyer pay option, lender may have a table of rates, right? If you pick a 6.375, the lender may give you $3,000 credit. That $3,000 credit could be eventually your commission. You can keep it, and then you can ask the buyer to pay 1%, right? 1% is what? Let's 400,000. You make 4,000. The lender credit pay you 3,500. You can keep that. Now you add up 7,500. So that's all your commission. But guess what? The buyer may have to not only pay 1%, might also have to pay all the fees as well. And end up the buyer may have to pay, $4,000. Beside 1%, the buyer may have to pay $4,000 in addition, right? So the buyer may have to pay $8,000 in total, right? You may feel guilty, so you give back some credit the lender give to the buyer to lower that total cost. Okay, so that gives you the flexibility on how you want to collect your commission, and that is how you want to be competitive in the market. Okay, but also think about yourself too, because you need to bring money home to feed your kids, to buy the diaper. You don't always give. So that's a bad thing about lenders out there, that because of competition, because of the volume, right? Lender with great volume, they can go lower, right? But that actually drive the market, the competition like really harsh, right? So like I say, you have a full control of this. You have so many different options, right? That's how you're gonna collect the your commission. It's flexible, right? So hopefully that answers your question. Good. Anybody have any other questions? So think about it, right? Let's say if you have so that also means that if you stay within the community that have the high competition, you may make less. But if you tap into the community that they don't pretty much care, right? As long as you give them a loan, right?
Yeah.
And also
So
meaning that if you take on not only conventional, but if you take on FHA, VA, think about that. You may get 2%, you may get 2.75%. And if you happen to have a loan that a 1.5 million, think about that. 2.75 or 1.5 million loan, that's like crazy, right? Literally could be 30 grand, right? So that's also saying that you are not only serving the loan product, conventional loan product, or QM loan product, maybe you focus on the non-QM product too, because that's how your commission drives, right? And maybe focus on the non-traditional loan, which is a VA FHA, right? That's how you get the money too. Cool.
yeah,
When you talk about
so
money, when you're talking about money, it's so exciting.
yeah, so lower commission, lower closing cost, so it means you are more competitive.
Yep. And now think it this way. We will just only talk about the MLO. What happens if you have both MLO and realtor licenses? Okay. So let's pick the scenario. You have a client that want to refinance cash out, so that client can get the money to buy the new home. So how many transactions is that? Refinance, loan for new purchase, and then the purchase of the home. 3 transactions in one. So now you have to calculate, and then how you're gonna surrender some of your commission. Let's say for the refinance, so that you can get the money for the borrower to buy to purchase another home, get a loan for purchase that, and also commission for buying the home from the real estate side. That's crazy. Let's stop late up that anybody knows, right? So like I say, this real estate is really interesting when you think about it, and when you understand the whole big thing, right? Right now, the goal is that I want to teach you about the MLO, the law, the practices, and all that. But eventually, you're gonna get out of my class, you get your license, and now you step in the real world, right? And now you have to find a way to make your money. And once you have a foot on the foundation, now you have to play around with your tricks to get the maximum money that you can get. Yeah. Cool. Crazy.
Yep. Thank you.
Yep. Anybody have any other question? Anything? Okay. If not, then I'll see you tomorrow. Have a good night.
Thank you.
Thank you.